Why keeping more than $25,000 in one bank account could quietly be working against you in 2026. Most people believe the number that matters is the one printed on the monthly statement. Others think it is the balance they check every morning on their phone before breakfast. But there is another number operating behind the scenes, one most account holders never think about. That number exists inside automated banking systems running continuously in the background at financial institutions across the country. If your checking or savings account regularly carries balances above $25,000, there are several financial consequences happening simultaneously, often without you even realizing it. First, your money may be losing purchasing power every single month because traditional bank accounts often pay interest rates far below inflation. Second, large balances inside ordinary retail accounts can occasionally attract additional compliance reviews depending on transaction behavior. Third, the bank itself may be using your deposits to generate significant profits through lending activities while paying you only a tiny fraction in return. None of this means you have done anything improper. None of it requires suspicious activity, risky behavior, or unusual financial decisions. It simply means many Americans are storing larger amounts of money than necessary inside low performing retail accounts that were never designed to hold long term cash reserves efficiently. This discussion explains how modern banking systems monitor account activity, why certain transaction patterns receive additional attention, how inflation silently reduces purchasing power, what the actual FDIC insurance limits are, and where many financially experienced retirees and savers choose to keep their liquid reserves instead. The example that helps explain everything. Imagine a retired electrician, 68 years old, who spent more than 3 decades with the same union. He owns his home outright. He receives a modest pension and Social Security benefits. He has roughly $140,000 sitting inside the same savings account he opened at age 19. He is not wealthy. He is careful, conservative, responsible. Last winter, his daughter prepared to purchase her first home in Florida. The down payment required was $22,000. Helping his daughter buy that home represented something deeply important to him because he had spent his entire life saving specifically for moments exactly like this. On a Tuesday morning, he walked into his local bank branch and requested a cashier's check payable to the title company handling the closing in Tampa. The teller looked at the screen for a moment longer than expected. Then she politely asked him to have a seat. A branch manager appeared a few minutes later and escorted him into a private office. The questions began. Why was he withdrawing the money? Who exactly was receiving the funds? Had anyone pressured him into making the transaction? Had he recently received suspicious emails or unexpected phone calls? Had he communicated with anyone online he did not personally know? This retired electrician suddenly found himself being questioned by his own bank simply because he wanted to help his daughter buy a home using money he had spent decades earning and saving. The branch manager eventually explained that the withdrawal required an additional compliance review and that processing the cashier's check could take up to 48 hours. He had to call his daughter and explain that the closing might be delayed. 2 days later, the check cleared. He assumed the situation was over. But several weeks afterward, he received written communication informing him that the transaction had been reviewed and documented internally for regulatory compliance purposes. Again, he had done absolutely nothing illegal. He was simply a retired father helping his daughter purchase a house. Yet the combination of a large account balance, an unusual withdrawal pattern, and a significant transaction outside his normal history was enough to trigger additional scrutiny. That situation captures the broader point of this entire discussion. Most people think the biggest banking risk involves fraud or account theft. In reality, one of the largest hidden risks is leaving substantial amounts of money parked in accounts that quietly work against your long-term financial position. The two banking rules people often confuse. The first rule most Americans have heard about involves the $10,000 cash reporting threshold. Under federal banking regulations, financial institutions generally file currency transaction reports for cash deposits or withdrawals above certain limits within a single business day. These reports are part of broader anti-money laundering and fraud prevention systems used throughout the financial industry. The reporting itself is routine. What surprises many people is that ordinary customers often never know when such reports are created because the process happens automatically inside the institution. However, the more important issue for most retirees is not the standard reporting threshold. The larger concern involves suspicious activity monitoring systems. Unlike routine cash reporting rules, suspicious activity reviews do not rely on one fixed dollar amount. Instead, modern compliance software looks for behavioral patterns. Banks evaluate whether transactions differ sharply from your normal account history. The systems are designed to identify anomalies, not necessarily wrongdoing. That distinction matters. If someone normally withdraws only a few $100s each month and suddenly requests several $1,000s, automated systems may flag the transaction simply because it falls outside the account's historical pattern. The software does not understand life context. It does not know whether the money is for a kitchen renovation, a wedding gift, travel expenses, medical costs, or helping a child purchase a home. It only recognizes unusual movement. Banks generally prefer to investigate first because regulators impose significant penalties when institutions fail to review suspicious patterns properly. As a result, compliance departments often operate conservatively. That means perfectly legitimate activity can occasionally receive additional attention. 7 behaviors that frequently trigger reviews. Behavior 1: sudden changes in normal withdrawal or deposit activity. Suppose a retiree has averaged weekly withdrawals of $300 to $500 for 15 years. Then one morning, that person withdraws $8,000. Even if the reason is completely ordinary, the sudden deviation may trigger automated review. The system compares current behavior against historical baselines. The larger the difference, the higher the probability of additional scrutiny. Behavior 2: multiple transactions spread across several days. Modern compliance systems no longer analyze transactions individually. Instead, banks often evaluate rolling activity windows spanning days or even weeks. Several deposits or withdrawals occurring close together can sometimes appear unusual depending on timing and structure. Financial professionals generally recommend conducting legitimate transactions transparently and maintaining clear records rather than attempting to break them into smaller pieces unnecessarily. Behavior 3: first-time wire transfers. Retail checking accounts that have never sent wires before may receive additional monitoring during their first outgoing transfer. Banks cannot immediately determine whether a transfer represents normal activity or potential fraud. As a result, the transaction may undergo verification procedures. Behavior 4: round number transactions near reporting thresholds. Deposits involving precise figures such as $9,000 or withdrawals of exactly $7,500 can occasionally appear unusual because automated systems are trained to identify recognizable patterns associated with threshold awareness. Ironically, attempts to appear organized or cautious sometimes create the exact transaction pattern software systems are designed to monitor. Behavior 5: account activity inconsistent with known income sources. If a retiree primarily receives pension deposits and Social Security income, but suddenly deposits a large amount of cash, the bank may request additional documentation. This does not mean the money is considered illegal. The institution simply needs enough information to satisfy compliance requirements. Keeping records for vehicle sales, insurance proceeds, inheritance payments, or business transactions can make these situations much easier to resolve. Behavior 6: third-party deposits. Cash deposits made by relatives, friends, or other outside individuals into your account sometimes receive elevated attention because they differ from ordinary account activity. The same applies to unusual deposit locations or after-hours transactions. Behavior 7: geographic or industry-related risk indicators. Financial institutions maintain internal lists of regions, merchant categories, and industries that receive heightened scrutiny due to fraud trends or regulatory guidance. Ordinary transactions connected to those categories may receive additional review even when the customer has done nothing wrong. Now let's move to the second issue, the one affecting nearly every retiree, regardless of banking activity. Inflation, the invisible financial drain. Many people focus entirely on account safety while ignoring purchasing power. But purchasing power is what determines how much your savings can actually buy over time. In 2026, many traditional checking accounts still pay extremely low interest rates. Some savings accounts pay slightly more, but many remain well below inflation. If inflation runs near 3% annually, while your bank account earns close to zero, your money quietly loses value every single year. Suppose someone keeps $100,000 inside a standard checking account, earning almost no interest. If inflation averages 3%, the real purchasing power of that money declines by roughly $3,000 annually. The account balance itself does not shrink. The damage happens invisibly. Your dollars simply buy less. Groceries cost more. Insurance premiums increase. Medical expenses rise. Property taxes climb. Utilities become more expensive. Meanwhile, the money sitting inside the account remains essentially stagnant. At the same time, the bank may lend deposited funds through mortgages, personal loans, auto financing, and credit cards at dramatically higher rates. This difference between what banks pay depositors and what they earn lending the money is one of the core foundations of retail banking profitability. Again, this is not wrongdoing. It is simply how the system works. But many retirees never fully realize how expensive long-term idle cash balances can become. The FDIC insurance issue. Another overlooked concern involves deposit insurance limits. The Federal Deposit Insurance Corporation generally insures deposits up to $250,000 per depositor, per insured bank, per ownership category. Most people assume all money held at a bank is automatically protected regardless of amount. That is not always true. If someone maintains balances significantly above insured limits at a single institution, amounts above those limits may face uncertainty during a bank failure. Now, many banks are financially stable, but history shows that bank failures can still occur unexpectedly. In 2023, several major regional banks collapsed within a short period. Government agencies intervened aggressively to stabilize the situation. However, those events reminded depositors that even large institutions can encounter serious financial stress. The important lesson is diversification. Keeping very large sums concentrated inside one retail institution may expose retirees to unnecessary risk. So, how much money actually belongs inside a normal checking account? Many financial planners recommend maintaining enough for monthly spending needs, emergency liquidity, and short term expenses. For many retirees, that amount often falls somewhere between $15,000 and $25,000. Beyond that level, additional funds may benefit from placement in accounts designed to provide better yield, stronger diversification, or greater inflation protection. 5 places where experienced savers commonly keep liquid reserves. Option 1, high-yield online savings accounts. Online banks frequently offer savings rates substantially higher than traditional local institutions. Because online banks operate with lower overhead costs, they can often pass some of those savings to depositors through improved interest rates. Many of these accounts remain fully FDIC insured within applicable limits. Transfers typically complete within several business days. For retirees who want simplicity, liquidity, and stronger yields without major complexity, this is often the easiest starting point. Option 2, Treasury bills. Treasury bills are short-term obligations issued directly by the United States government. They are available in multiple durations, including 4-week, 8-week, 13-week, and longer maturities. Treasury bills have become increasingly attractive during periods of higher interest rates because they often provide competitive yields while also carrying exemptions from state and local taxes. Many retirees build Treasury bill ladders. Treasury, that means staggering maturity dates so portions of the portfolio become available regularly. This structure helps maintain liquidity while still generating interest. Option 3, Series 1 Savings Bonds. I-bonds are designed specifically to help savers protect purchasing power during inflationary periods. Their rates adjust periodically based on inflation data. These bonds include holding requirements and annual purchase limits. But for long-term conservative savers, they may provide useful inflation protection backed by the federal government. Option 4, Brokered Certificates of Deposit. Brokered CDs available through major brokerage firms allow retirees to access offerings from multiple banks simultaneously. Instead of opening separate accounts at different institutions manually, investors can spread deposits across multiple banks through one brokerage platform. This can help maintain FDIC coverage while improving organization and potentially securing higher rates. Option 5, government money market funds. Government money market mutual funds invest primarily in short-term Treasury securities and government-backed obligations. Although these funds are not FDIC insured, many retirees appreciate their liquidity, simplicity, and relatively conservative structure. Funds are often accessible within one business day. Now let's discuss the structure many financially experienced retirees prefer. A common approach looks something like this: 1 to 2 months of living expenses inside a standard checking account for everyday bills, several additional months of expenses inside a high-yield savings account for emergency liquidity, intermediate reserves allocated to Treasury bills or short-term government securities, longer-term emergency cash spread across CDs or government-focused brokerage products. This type of structure may improve yield while maintaining reasonable liquidity and diversification. Importantly, it also reduces the amount of idle cash sitting indefinitely inside ordinary low-interest retail accounts. 3 situations retirees should prepare for before they happen. Situation 1. Required minimum distributions. Once retirees reach the age requiring mandatory retirement account withdrawals, large deposits can suddenly appear in checking accounts that previously maintained smaller balances. Directing those deposits into prepared savings or brokerage accounts can sometimes simplify cash management. Situation 2. Pension lump sum payouts. Some retirees receive opportunities to take pension distributions as large lump sums instead of monthly payments. Those transfers can involve 6-figure amounts. Planning the destination account in advance can help avoid unnecessary complications. Situation 3. Survivor benefits and inheritance distributions. Life insurance proceeds, inherited retirement accounts, and survivor benefits often arrive during periods of emotional stress. Families who already have secondary accounts established frequently navigate these situations more smoothly. The practical first step. For retirees currently holding large idle balances inside ordinary checking or savings accounts, one of the simplest improvements may involve opening a reputable high-yield savings account and gradually transferring excess reserves beyond immediate spending needs. From there, additional diversification into Treasury bills, CDs, or other conservative products can happen slowly over time. The key idea is not complexity. The key idea is intentional placement. Every dollar should have a purpose. Daily spending money belongs in highly liquid accounts. Emergency reserves belong where they remain accessible. Longer-term savings should ideally earn enough to reduce inflation damage whenever possible. Most traditional banks are unlikely to actively encourage customers to move large balances elsewhere. Low-cost deposits are valuable to the institution. But retirees who spent decades building savings deserve to understand all available options. The information is public. The tools already exist. The accounts are available. What matters most is understanding how the system works and making deliberate decisions instead of leaving large sums sitting passively in accounts that may quietly reduce long-term financial efficiency. Your savings represented years of labor, years of discipline, years of delayed gratification. They deserve careful management during retirement. And in many cases, even small adjustments in where money is held can create meaningful differences over a 20-year retirement horizon. This content is educational and informational only. It does not constitute financial, tax, investment, or legal advice for any individual situation. Banking regulations, interest rates, insurance limits, and financial conditions may change over time. Always consult a licensed financial advisor, accountant, attorney, or tax professional familiar with your personal circumstances before making decisions involving investments, retirement accounts, banking arrangements, or major financial transactions.